Yes. What if everyone said it just a little more? Would the world be a better place? A nicer place? At MU Health, we're certain of one thing, that yes makes the world a healthier place. Yes is the strength to fight doubt, the fuel to find cures, and the unbreakable resolve to keep pushing further. At Mid-Missouri's only academic health center, yes isn't just changing lives, it's saving them.
Good morning and welcome to Radio Friends on Wednesday, August the 17th. We've got Mel Zelenak with us today.
Hi, Paul.
Pleasure
Great
to have you
seeing you
here,
again.
Mel. And we're going to try to squeeze in two different topics.
Actually, three. I
Okay.
forgot to mention one of them. The
All right.
first one is my anniversary is next week.
Oh, congratulations.
Thank you. We've been married 48 wonderful years.
Yeah?
We've been blessed with 2 kiddos and 2 grandkiddos, and we're in hog heaven.
Well,
So.
happy anniversary to both of you. And since you're so thrifty, that means you don't have to send your wife a card,
Well,
right?
why do you think I'm announcing it on air?
Mel Zelenak. All right. So the first one's out of the way. You wanted to talk about asset allocation, and then we'll pass along some money-saving travel tips.
Yes, and because I'm a former teacher, I like to talk about what we covered last time. We started with travel tips. We talked about understanding supply and demand in the travel industry and how important it is for cruises and airfare and basically all kind of travel hotels and everything.
Yeah, supply and demand. When there's a high demand for it, prices go up. When there's a lower demand, prices go down. And it's important to you as a consumer to check it on a regular basis and be flexible with your
Perfect. I'm
be
glad you
flexible
said
with your
flexibility.
dates.
Yeah, and we did talk about the study that was done. 3 out of 4 investors think they have a fiduciary relationship with their financial planner, when in reality, almost no one in your audience or in our audience has a fiduciary relationship with their financial planner, and only those people who deal with fee only, where the client is being charged an hourly fee or a yearly fee based on assets, which is usually about 1%. Vanguard does it at 0.6%. But any other people out there, trust me, you're not dealing with somebody who's got your best interest in mind. So keep that in mind. And fees do matter, obviously, and that's the key. And we pointed out that anywhere from 60 to 70% of your entire portfolio, if you've invested over a long period of time, 30 or 40 years, is going to go to the fees that you're paying, because it's compounded. And every year, these fees compound. It's like compound interest, but it's in reverse. And we're going to pick this up, and I want to show you how relatively easy it is to basically do a lot of this stuff on your own. You can get a little bit of help, but if you do it on your own, it literally takes, I say 3 hours a year. It probably takes us less than 3 hours a year. And here's how you do it. You start with deciding on your asset allocation, and that's really the most important thing. And typically, asset allocation is going to be 3 types of investments that you're going to consider. Most people deal with stocks, stock funds, bond funds, or some kind of cash equivalent like money market funds or CDs. Okay, so a general rule of thumb that's used, and you've probably heard of this many times, Paul, that most people will want to take your age and subtract that from 100, and the answer is the percent of your portfolio that you want in stocks, because stocks are more volatile, more risky.
So if you're 70, you should have about 30% of your investment in stocks, and the rest
in some kind of cash equivalent or bonds.
Okay.
But
the
bonds.
younger you are, the more tolerable you could be to taking a risk, because you've got more time to make up those losses.
Exactly, and we know historically that stock funds will be much better than the other types of funds that we're working with. The
but
bond
you got to
fund.
have the stomach.
Exactly.
For it. You have to have the stomach for it to weather the downturns.
And that's why, in a way, I don't necessarily like that age example that I gave you, because there are so many questionnaires out there now, and almost all of them are very, very good, and they consider not only your age, but your risk tolerance, what you just said. And also, do you really need the money? Some people, believe it or not, and it's you, for example, don't need the money, okay? So you may never need your money. So you might be 70 years old or 80 years old, and believe it or not, you may even be in 100% stocks. Now, that's very, very unlikely.
It depends on what your risk tolerance is there.
But the questionnaire is key. I use Vanguard's questionnaire, but there are many, many of them out there that are just as good. I have kind of a summary of 3 or 4 or 5 of them. I'm happy to email those to anybody, and they could consider which questionnaire they want to use. They're all free.
Okay.
And they only take maybe 5, 10, or 15 minutes maximum to complete.
Okay, so if people want it, we're almost out of time here, Mel.
Oh, okay.
What's your email address?
Mel's Cruises at charter.net.
Okay.
All right, number 2, quickly, open an account with one of 3 companies is what Solon recommends, and I concur. The 3 companies, Vanguard, Fidelity, or T. Rowe Price is what he suggested at the time. Vanguard is rated number 1, by the way, by Consumer Reports in their most recent magazine article, and out of 67 companies. And then the third one is select your investments. And again, all you're gonna do is look at total stock market. Most people will, index funds, total international stock index funds, and total bond market index funds. This is a little simplistic here because we are running out of time, but those are 3 that people would generally at least consider. There are others out there, but those are pretty good options because they do cover a wide range of the market. Mm-hmm. And the last step is to rebalance your portfolio. If, for example, your stock funds do very, very well one year, if it's a risk to you, you may want to adjust that, mm-hmm. and you may want to adjust it as much as twice a year.
Okay.
So,
what does Warren Buffett do?
Warren Buffett, by the way, suggests that his heirs do exactly what we're talking about here. In other words, he's suggesting that they invest in broad-based mutual funds, and he prefers Vanguard over any other company in the world. Warren Buffett.
Is he the wealthiest man in the United States?
No.
Okay, he's pretty close, though.
Pretty close.
Yeah, all right, behind Mel Zelenak. Mel, thank you so much for coming by.
Behind Paul Pepper.
Tomorrow, Council for a Drug-Free Youth. I appreciate you coming by, Mel.
Thanks, Paul.
If there's something you would like to hear or see, I would love to hear from you. Just drop me an email. That's pepperp@missouri.edu. And if you're going out, have yourself a nice day and be nice to each other. Bye-bye.